Now, have you heard about those big banks failing? Yeah, it's got a lot of people worried about whether their own bank is safe. Today, I want to talk to you about what's been going on. We'll cover the big bank failures, why the government is stepping in to help, and why some people are happy about it while others are upset. And of course, we'll talk about what's going to happen next. So let's get started. You're watching the Digitalist Hub. Now, 3 banks in the US went bankrupt recently. We're talking Silvergate, Signature Bank, and Silicon Valley Bank. Now, Silvergate was the little guy with about 11 billion in assets. Signature was a medium-sized bank, and Silicon Valley Bank was the big dog in town. So it's interesting to note that Silvergate and Signature Bank were pretty popular in the world of crypto, while Silicon Valley Bank was a big player in the tech startup scene. But here's the thing, all 3 of these banks actually failed for similar reasons. They had a run on the banks. That's when too many people try to take out too much money too quickly, and the banks don't have enough cash on hand to give everyone what they want. Now, some people might try to compare what happened to these banks with the crypto crash in 2022, when a bunch of companies like FTX went under. But there's a key difference here. See, those crypto companies were actually insolvent, which means they didn't have any money to give back to their customers when they tried to take it out. But these banks we're talking about were illiquid, which means they did have the money, but some of it was tied up in long-term investments like bonds. So it wasn't that they didn't have any money, it was just that they couldn't access it quickly enough to meet the demands of all their customers. I want to make sure we're clear on something. These 2 things we're talking about, insolvency and liquidity, are actually different, but sometimes things can get a little confusing. See, when a bank run happens, it can start as a liquidity problem, meaning the bank doesn't have enough cash on hand to give to everyone who wants it. But if the bank has to sell what it owns, like treasury bonds, to get cash, it can become an insolvency problem, meaning the bank doesn't have enough money to pay all its debts. Treasury bonds are actually one of the safest investments out there, and lots of people, even your grandparents, invest in them because they provide a stable rate of return. And banks invest in them for the same reason. Let me give you an example to help you understand. Let's say you're Signature Bank and you've got billions of dollars from your customers to keep safe. Where do you put all that money? Well, you might invest it in treasury bonds, which can earn you a stable 1% return each year. You keep some cash on hand for when people want to take their money out, but you figure if you need to sell those bonds, you can do it pretty easily. But what if interest rates suddenly go up really fast? Suddenly the government is selling new bonds that give 5% return, while your old bonds are only giving 1%. Because of this, the value of your old bonds on the market drops, and if you try to sell them, you actually lose money because they're worth less than what you paid for them. Okay, let me break this down for you in simpler terms. If you kept those bonds until they were due, you will still get your 1% return and not lose any money. But when lots of people want to take their money out of the bank at the same time, the bank can't just hold on to those bonds because they need cash to give to their customers. So they have to sell those bonds even if they don't want to, and they end up losing money because they have to sell them for less than what they paid for them. This made the problem worse, and the banks had to close down because they didn't have enough money to give to all their customers who wanted to take their money out. So you might be wondering, what happens now? You might have heard that the government guarantees bank deposits, but there's actually a limit to how much they'll insure, up to $250,000 per account. But in some of these banks, like Silicon Valley Bank, they had a lot of accounts with a lot more than that. Some of these accounts belong to venture capital and startup companies with millions of dollars in them. And when the bank failed, these companies suddenly couldn't access their money, which meant they couldn't pay their employees or keep their business running. So a lot of people are now calling for the government to guarantee even more people's money in the bank so they don't lose everything if something like this happens again. An example of this is Jason Calacanis tweeting, "You should be absolutely terrified right now. That is the proper reaction to a bank run and contagion. Guarantee all deposits up to 10 million or this will spiral into chaos." The discussion around comments like these led to a big argument about whether the government should intervene. The question was finally answered on Sunday when the US Treasury released a statement which said, "Depositors will have access to all of their money." So, some big news. The US government just stepped in to help 2 banks, Silicon Valley Bank and Signature Bank. They're doing this because they don't want people to panic and start taking out their money from the banks. They want you to feel confident that your money is safe in the banks. But some people are saying that this isn't a good thing. Some people were fast to notice that the government often only intervenes to assist certain group of individuals, and this situation was no exception. Mark Cuban, bail out Silicon Valley Bank tonight. Feds, approved. Goldman Sachs needs $824 billion. Feds, approved. JP Morgan Chase needs $416 billion. Feds, approved. Average Joe, my wife has cancer, can we get Medicare? Feds, we're broke. Some people are saying that the government only helps certain people when there's trouble, and not everyone is happy about it. But some people think those people are wrong because the government is only helping the regular folks who put their money in the bank, not the rich people who run the bank. But here's the thing, some of those rich people who run the bank might have already taken their money out before the bank had problems, and that's shady. Especially when you find out that the CEO of Silicon Valley Bank, Greg Becker, sold a whole bunch of his own shares before the bank had problems. And to make things even worse, he was one of the people who wanted to change the rules so his bank could do whatever it wanted without being watched too closely. According to Heather Landy, the ability of these banks to fly under the radar in the US was no accident. Greg Becker, SVB CEO, lobbied US officials several years ago to raise the asset threshold at which banks would be considered systemically important. Now, you know how banks have rules and regulations they have to follow? Well, there are some banks that are really big and have a lot of money from a lot of people. These are called systemically important banks, because if they were to fail, it could cause big problems for the whole economy. But there are also smaller banks that don't have as much money from as many people. These banks don't get as much attention from the people who make the rules about how banks should behave because they're not considered as important to the economy. Here's the thing. Sometimes those smaller banks do risky things with their money, and if those risky things go wrong, it can cause problems for a lot of people. When that happens, those smaller banks can become systemically risky. Now, normally these smaller banks wouldn't get as much attention from the government, but when they become systemically risky, they suddenly get a lot more attention. This is because if they fail, it could cause problems for the whole economy, just like with the bigger banks. So what does the government do? They give these systemically risky banks a bunch of extra money to help them stay afloat. But some people think this isn't fair because those smaller banks didn't get the same rules and scrutiny as the bigger ones in the first place. Think of it like this. Imagine you have two friends who are both terrible at managing their money. One of them is rich and the other is poor. You might pay more attention to the rich friend's money habits because they have more money to lose. But if the poor friend suddenly starts spending money recklessly and gets into debt, you might have to help them out too, even though they didn't get the same level of scrutiny as the rich friend. This recent banking situation in the US has everyone talking about the possibility of a financial crisis. But wait, let's not jump to conclusions just yet. Let's consider this before we get too worried. Firstly, while the situation will be harmful to venture firms and their financial situation, depositors are likely to get some of their money back, with some possibly getting all their money back. The same can't be said for investors though, as they are low on the priority list. However, the assets should help cover these deposits, and the FDIC should eventually pay out to depositors and creditors. Secondly, this situation is different from cryptocurrency collapses we've seen before, as regulators and financial institutions are paying close attention to the issue and they're motivated to see it resolved in a sound way. Thirdly, the scope of the situation is currently limited. These are regional commercial banks that operate in specific areas, and they cater to companies, not individual households or retail bankers. It's unlikely we'd see a situation like this with bigger banks like Bank of America, who have a more diversified client base that isn't as exposed to the specific industry risks faced by these other two banks. So, while there will be fallout from this situation, it's important to remember that this is not on the same scale as the 2008 financial crisis, and the fundamental issues at hand are different. It's tied to a bank run and concentration risk primarily, and there's no same level of negligence at play here. Nonetheless, the situation is concerning, and we'll have to see how things play out. That's it for today's video. I hope you found the information useful. If you did, please make sure to like and subscribe.